Hi, my name is Lo Liebenberg, and I am the CEO of PayProp in North America. And today we're talking about trust fund segregation. It is an issue that we don't often think about. Everyone tends to understand it at a fairly basic level, but there's actually a lot more depth to it than just segregating trust funds from business funds. So we are going to just walk into a little bit of that, and it should only take 15-20 minutes. So I want to talk a little bit about who we are, because often when you start talking about things like this, the question is, well, who are you to be allowed to say these things? And so this is who we are. I mean, PayProp is a international company that is processing residential lettings for thousands of property managers. But before we get there, we just need to quickly run through the disclaimer that just says, look, I'm not a lawyer. I'm from a payment specialist company that deals with property management. And as such, we deal with trust funds. So we have a view on trust funds. We have an opinion on trust funds. And we read the law, and we're quite a conservative in how we deal with these things. But ultimately, we're not lawyers. So everything that we say, check it with your lawyer, double check it. We're not trying to give you legal advice. We're only going to try and give you an opinion that's based on our experience in the trade. So PayProp was established in 2004, so we've been around for a while. And we've headquartered in the UK, and we've got operations in the US, UK, Canada, and South Africa, and we've got a sister company in Switzerland. And we process roughly $1 billion worth of rental in a year. And you'll see the type of clients that we do it for. And those are just a selection of larger key account clients that we do it for. Well, we've got thousands of clients all over the world. We're relatively new in the US. And then if you look at the type of banks that we have relationships with, and you'll understand why banking relationships are important towards the end of this, is every market that we trade in, we partner with a bank, and we utilize those transaction rails to transact in the markets, and you'll see how it works later. But these are the type of banks we associate with. We've been doing this for quite some while, and we've got some really sort of serious banks that we work with. The idea of PayProp originally started in Givengain. I would encourage you to go look at the Givengain website. Givengain is our founding story. What we have today as PayProp uses that technology. And it was started by two brothers who believed that it's better to give than to gain, which is where the name comes from. And they created a global philanthropy movement where normal people like you and I are able to raise money for good causes. And in a way, what Givengain does, it actually curates charities to make sure that they're real, legitimate charities. It checks all the paperwork. It makes sure that they set up their accounts so that you don't just fund some random guy who says he's got a charity. We curate the charities, and then we allow a transaction platform through which people, on a very transparent basis, are able to donate to causes that they find interesting, and to set up fundraising drives. And you'll see by the type of charities that we've raised funds for across hundreds of countries in the world that we've been doing this not just for a long time, but we're doing it for really serious charities and organizations around the world. So we are a fairly large payments company with these two verticals. The one is charities, in which we trade in like 195 countries, and then the property verticals, which are more involved and country specific. And then just a little bit about me, because I'm new in the US. It's important just to get some credentials out there. I've only been in the US since 2019 as the CEO of PayProp North America, native to Miami. And prior to that, I was the CEO of PayProp in South Africa from 2011. And we built up PayProp in South Africa to be the largest processor of residential letting transactions in the country. And in the process, we launched a tenant-specific credit bureau. I launched a deposit management advisory firm. I launched automated legal partnerships for eviction, created the first rental index. So we did really a lot of stuff there that ingrained us into the industry. In terms of qualification, I'm a broker in the state of Florida. I've got an MBA, I've got a master's degree in public development management. I'm certified in South Africa as a master practitioner in real estate. And I'm also then certified by the Financial Services Board to manage long and short-term deposits. So I've been in this game for a decade. And I'm just bringing you the good, the bad, and the ugly of everything that we see. And feel free to find me on LinkedIn. I post articles every now and then if you're interested. So the outline for today's session, and as I say, it's a fairly short and punchy session, is that we're just really looking at these 5 points. We want to define the broker-landlord relationship. We want to talk about segregation of trust in business, segregation of owner funds, segregating security deposits, and what do we do with last month's rent. So let's jump in. So we all know that in the state of Florida, and I'm talking literally just as a Florida broker here, is that when you manage property on behalf of a third party, then you have to be registered as a property broker. And in fact, in the entire federal US, there are only 5 states that don't require you to have a license in order to process residential rentals. So in most other states, you need to be registered as a property broker. And then, especially if you look at Florida law, the brokerage relationship is not very explicitly defined in the statutes in 475. So there's a lot of writing about when you're selling property, and then there's this little caveat that says the real estate license disclosure requirements, so in other words, in what type of agent you're acting, does not apply to rental or leasing property. So then, well, as what do you act if you are a property broker? We would argue on a very conservative basis that the role that a property manager plays relative to a owner is that of a single agent, because you are acting in the sole benefit for that landlord. And as such, if I assume this position of single agent duty, I have the duty to do honestly and fairly. I've got the duty of loyalty, confidentiality, full disclosure, accounting for funds, skills, care and diligence, presenting offers, and disclosing all known material facts. We would argue that the landlord property broker relationship fits that single agent model of duties. Another reason why I would argue it is if you go read most of the exclusive property management agreements that people end up signing, they embody the same principle. They basically say, I will use due diligence and care to manage and operate your property. I will collect funds on behalf of you, and I'll manage your tenants, which essentially then puts you in the feet of the landlord. And if you then go look at something like in the National Association for Residential Property Managers, their code of ethics also defines this relationship as one that embodies a fiduciary responsibility to the client. Now, just digging into fiduciary responsibility, that basically just means that you are putting the interest of your client, which is the landlord, above those of your own. And that means you must exercise a standard of care that puts the interest of that owner above that of you as a property manager. And that fiduciary responsibility is a heavy responsibility to carry. It's quite a heavy duty that you have on your shoulders. And they have certain implications, and they've got 2 types of implications for property managers. So on the one is it sets you up for a series of obligations towards the state, and the other one, it sets you up for a series of obligations toward your client. Now, interestingly, when you look at assuming this fiduciary responsibility, where you say, I will act as your fiduciary for the management of your asset, which is your property, and I will formalize this in an agreement, and I will look after your interest. The state actually puts 3 levels of obligation on you. So the one is that if you look at Statute 475, it basically says, as a licensed entity, as a licensed realtor, as a licensed property manager or property broker, there are things that you need to do if you assume this relationship. In other words, you need to receive funds in a certain way, you need to put them in trust, you need to store them in a certain way. So you've got obligations towards the state that says, if you choose to do this, you do this under this set of rules. Administrative Code 61J2 then also gives you a little bit more practical grounding on the how. So 475 says what you must do, put it in trust. Administrative Code says, well, how do you put it in trust? And it defines the obligation of, for example, reconciling a trust account every 30 days. But then there's a statute that we often forget, which is 83 of the statutes, which is the Tenant Landlord Act. In many instances, the type of broker agreement that you sign puts you in the feet of the landlord, where you literally say, I will assume some of your duties as a landlord. I will select a tenant for you. I will contract with that tenant. I will manage that tenant, which then means if I stand in the feet of the landlord, I assume some of the landlord's legal obligations in how I treat my tenants. So by accepting the fiduciary responsibility of managing a property, I have these obligations toward the state at these 3 levels. What I do, how I do it, and who do I do it for. Accepting fiduciary responsibilities towards my client is broadly defined in 475 as I've got duties of action, I've got duties of protection. In terms of duties of action, I've got to care for my client, I've got to be obedient to my client, and my client says, I don't want that tenant, and we put the tenant, and I've got to disclose to my client. If I looked at duties of protection, it just means confidentiality and, very importantly, accounting for funds. And we're going to get back to accounting for funds, and loyalty towards my owner. So I want you to really focus on accounting for funds and loyalty, because those are very, very, very important for all the later discussions. So the implications here for the first level of segregation. Now, when I speak to property brokers in Florida, and I ask them about segregation, this is the first answer that I get. They say, well, I segregate trust funds from my business's funds. And that is important. That, to me, is the base level of compliance that everyone needs to stick to. Unfortunately, in the state of Florida, we haven't come across a lot of people that intermingle. I mean, we've come across one or two, but most of them have a separate trust account, and we've been able to help those one or two fix themselves by having PayProp account. But I mean, you can all read the law. It's fairly clear that what's defined as a deposit is anything that you receive on behalf of another person. So rent is considered as a deposit because you're not receiving it for yourself. And if you receive that deposit, you shall immediately place it in an insured trust account. And then it just defines what a trust or escrow account is, and then it talks about no personal funds of the licensee shall be deposited or intermingled with any other funds held in escrow. So these funds are completely separate from your business, and there is allowance for property managers or brokers who, if you do property management, you're allowed to hold $5,000 of your own or business money in that account to pay for any administrative expenses that relate to it. So there is that little exception, but $5,000 is not a lot of money when you look at average rentals in Florida. So what this really means, again, just to reiterate, it's a separate account. And what we've seen in international best practice, it's often a good idea to appropriately designate it. So if you give your accounts names, call this a trust account, because it alerts other people to the fact that these funds do not form part of your business account balances. Why is that important? Because if you were to go bankrupt, if you were to be liquidated, the liquidators can't come after these funds because they're not yours. You're holding them as a fiduciary in trust on behalf of other parties. And that's really important to give your landlords and tenants peace of mind that their money is safe, even if something happens to your business. Then there is the other implication. This is, well, you may not use this to fund any business expenses. And we will come back to that in a minute, because it sounds really, really, really simple to stick to that rule. But there are instances where people inadvertently break that rule. And we'll talk about it in a minute. You must account for it separately, and you need to reconcile that every 30 days. And again, just the word trust and trust fund implies that you've got this duty of care towards every person on whose behalf you hold and process funds. Now, there's should be very little disagreement at this point that is what trust fund segregation is all about. But here we get to second level of segregation, and that deals with your responsibility to every single landlord that you contract with. So you've got, as a property manager, a fiduciary duty towards every single owner individually. So just because you've got 100 landlords doesn't mean you act towards them as a collective or account to them towards a collective. Every owner is expecting you to account for their funds towards them as an individual. And in that accounting for the funds of the individual, your role is very similar to that of being an asset manager. You manage their asset and you produce them the highest risk-adjusted return for managing that asset. But where this sometimes goes wrong is that people cross-fund different owners' income streams. Now, you ask me how that's possible. Let me show you how it's possible. What we see in a lot of people before we take them on is that they've got this one bucket in which they receive all the rental every month. So there's one bucket, they put all the money in there. And then from that bucket, they make these bulk payments out. So I've got 100,000 in today, I'm going to pay 80,000 out. And then they either bulk export this payment file, or they just go and they write $80,000 worth of checks. When you're scooping that money out of the bucket and you look at that drop of water that you're about to throw into the banking system, the question you should ask yourself is, whose money did I scoop out? Because if I can't trace that money back to the individual property, I might end up in a situation where I am accidentally using property A's money to pay property B's expense. Now this happens in one of two ways. The one way that it happens is the tenant in property A hasn't paid yet, but there is a supplier that's really screaming. I've got money in my trust account and I'm quickly going to pay supplier B while I'm waiting for property A's money to come in there, because there's money in the trust account, sure, so I can pay it. But what I am doing there by settling the supplier that screams the loudest is property B, whose contractor I'm paying, hasn't generated income. So I am using property owner A's money to pay property B's expense. So I am neglecting my fiduciary duty towards property A's landlord, because money that should have gone to him, I'm using to do other stuff with. And just because it's paying another property's expense, it doesn't make it right. The second scenario is leakage. I'm not talking about theft. I'm talking about non-sufficient funds on ACHs or bounce checks. So I get $100,000 into my account. Some of the transaction amounts are pending, not cleared yet, but I need to pay it. So all that I'm doing is I'm writing up checks or I'm putting through bulk files. But then that failure happens. And I now say, well, I've already paid all my expenses. How do I allocate this failure now? Whose money haven't I paid? How do I undo this transaction? And that very often is the scenario that most clearly shows up, that you need to find a way to keep each owner's money separately and to only pay that owner's expenses with that owner's money. Now, the one way to do it would be to have a single bucket for that owner into which that property's money arrives and which you can only pay that property's expenses out of. But the reality then is if you have a lot of properties, you need to have a bucket or a trust account for every one of those owners if you want to do it properly. Now, some people make up for all these buckets by having really complicated accounting to take the money in the bucket and remember X milliliters is for landlord A and X milliliters is for landlord B and C and D and E and F. And that's how most accounting works, so that you can divide the money in the bucket up theoretically. But we've got a solution that does it quite practically that I'll show you in a minute. Then the third level of segregation deals with, well, what do I do with security deposits? And sometimes what we find is people have this one bucket, and that's called a trust account, into which all rentals and all security deposit comes. They then pay out the money as owners need it. And then what's left in the bucket they call the remainder of the security deposit, which we believe, again, in our very conservative view, is incorrect. Because if we look at the law, and we go to the Landlord Tenant Act, we go to Statute 83, it basically says that the money should be held in a separate account for the benefit of the tenants. The landlord shall not commingle such monies with other funds of the landlord. So if I think of this bucket in which I receive rentals, that rental money technically now comes into trust and it needs to be paid out to the owner. So what's in the bucket is owner funds. But now Statute 83 says to me, but I can't mix tenant funds, because remember, deposits belong to the tenant, with owner funds. So I should find another place to put it. Because the funds that are entrusted belong to the tenant, are entrusted to the agent to hold as security for the landlord against damage. But just because it's held as security for the landlord, it doesn't mean that the funds belong to the landlord or to the agency. It still belongs to the tenant. And therefore, it must be held separately and accounted for separately for the tenant. So it cannot, by definition, be part of the same processing bucket. And it's important to not just keep it in a separate bucket, but to also be able to account for it separately. So if we then go back to our bucket analogy, and I'm sorry, I'm going to make 2 more bucket analogies, and then I promise I'll stop. You should theoretically have this one bucket for all the trust funds for the property, but then have a small bucket in which separately you keep the tenant's money, right? But then again, I face this complexity of then, for every property that I manage, to have a large bucket into which all the rental processing funds are received, and then a small bucket in which I hold the deposits. And that becomes a lot to manage or account for. And then the last level of segregation really deals with the final month's rent. And we find some strange practices for final month's rent. So before we talk about the strange practices that we've seen, let's just remind ourselves what the statutes say. The statutes say, I may, as a landlord, receive advanced rent for any period that's not the next immediate period, right? Last month's rent. That money must be held separate trust account for the benefit of the tenant. And the landlord shall not commingle such monies with other funds of the landlord. And most importantly, these funds will not be used until such monies are actually due to the landlord. So if I'm holding on to last month's rent for the tenant, I can't give it to the owner now to use because last month's rent is not yet due. You may only disperse this money when the advance rental period commences. So the type of things we're seeing in the market is a lot of people just give the money to the landlord the moment it's received, and they hope that the landlord keeps it separately. Hope springs eternal, but what guarantee do you have that a transaction that you are involved in, where you've contracted with the tenant, that the owner sticks to this part of the deal, that the owner says, I am going to hold this money separately and not use it until it's due? I mean, we can all think what's going to happen. Because that advance rental has not been earned yet, those funds still belong to the tenant. And then we've seen another disturbing thing is where property manager says, oh, you know what I do is I've got to have an 8% finder's fee. I'm going to take that as my commission. But paying commission from the last month's rent is technically, according to this statute, wrong because the money hasn't been earned. That money should be held in trust. So technically what you're doing, you're doing conversion. You're paying expenses for the landlord for funds that aren't already due. So what is the solution? Again, I promise this is my last bucket slide, is, well, maybe I should have a bucket for every property and then have these two smaller buckets, one where I leave security deposit money because I need to keep it separate, and one where I keep the last month's rent because I keep it separate. And then if I multiply that by all my properties, that's a lot of accounts and accounting to do. I mean, literally, that's a lot of buckets. How do I deal with this? Before we get to the answer, let's just summarize what we've seen. If I take everything that we've talked about, everything from how I receive money in trust separate to my business account, how I need to receive and hold money separate for every landlord, how I need to hold security deposits separate from landlord funds, how I need to deal with my last month's rental. You can put it all into 3 sins for trust fund management that people commit fairly often. So the one is commingling. So obviously we know, don't mix personal funds with trust funds. Got it. But the second is, don't commingle security deposit and rental funds. So by all means, do not have a single bucket in which you leave the tenant security deposit plus process the rental in, on the assumption that after I've paid everyone, what's left at the bottom of the bucket is all security deposit. Technically, you should keep those funds separate. The second major sin is conversion. So that's paying yourself out of trust funds, settling your business expenses. And there's actually 2 types that we've come across. So the one is what we've talked about on last month's rent, where last month's rent gets taken as commission for the agent for finding a tenant. That is technically conversion. Those funds should be held in trust on behalf of the tenant until they're due. Paying yourself commission out of it is paying a business expense. The second part of conversion is paying business expenses from trust accounts or from trust funds. So sometimes what people would do is that they say, managing this $1,000 a month property, I'm going to earn $100 commission, and I will pay, instead of paying myself $100 commission, I'm going to pay myself $80 commission, and then I'm going to pay $20 towards the rent, whatever it is. All commission earned should be first extracted from the trust fund, then put in your business account, and business expenses get paid from the business account, not from the trust account. So it's important to not accidentally, and although you think I've earned the commission, I've earned the $100, what I do with it is my problem. You can't pay those business expenses out of the trust account. You've got to move them into your business account and then pay out. So you want to have the type of platform or account set up where you really can't do that. And then the last one, which is the vaguer one, but the more important one for me, is sometimes we do things in goodwill and with all good intent, where we fail the responsibility, the fiduciary responsibility towards our client. And our client in this case is the property owner. And that is where we use a pool trust account and we just pay out in the hope that we will receive all the money, where we are technically cross-funding expenses in property. Now, it sounds like it's harmless, but for the owner whose funds you are using to pay another property's expenses, it's not a harmless exercise. You are taking their money and spending it on another landlord. You are not looking after their interest. You are not treating their funds with care. Also, another form of failing in fiduciary responsibility is to misunderstand what security deposits are there for. Security deposits are there so that when the property is broken or neglected, that you can fix it up on behalf of the landlord. Often people use security deposits to pay shortfalls in rental. That's not what that money is there for. The money is there to protect the owner's asset. So remember, right in the beginning, we spoke about risk-adjusted return of an asset. The way that you reduce risk is by holding security. And the moment you utilize that security, you are failing in your responsibility to the owner to reduce his risk. Because should the tenant damage the property, there is then no more funds left to pay for those damages. And then the ultimate expression of not being able to account for funds, our ultimate expression of failing in fiduciary duty is if you can't properly account for funds, because that's all that the owner expects. If you think of what we defined right in one of the first slides about the duties of a single agent, if it comes to duties of care, one of those duties is to account for funds. So if I can't accurately account to every owner for every dollar received and every dollar spent down to the individual property level, I am failing that fiduciary responsibility. So thinking about those three sins for trust fund management, what are the type of questions that you should ask yourself sitting in this webinar? You know, am I ring fencing each property from the financial losses of the other properties that I manage? Am I keeping my security deposit separate from my rental funds? Am I ring fencing each tenant security deposit from other tenants so that I can account for them individually? Am I dealing with the last month's rent appropriately? Can I do this and account for all funds at all these different levels, rental, security deposit, last month's rent, and do the accounting in a way that I know it's true? And then the last part in all of this is how much complexity do I now have to manage if I want to do this properly? And that's where we come in as PayProp. So I promise I'm only going to show you 2 slides about PayProp. That's because you didn't attend this webinar in order to be sold PayProp. But I do want to show you our solution because it does show you the PayProp solution in the best possible way. And the best way to understand it, and I promised you I won't show you buckets, but I'm not done with the water analogy just yet. We don't use buckets, we use pipes. So if you want to imagine what a PayProp does, it's a funnel in which I receive all my tenant funds. But the beautiful thing about this funnel is it's got a separate pipe for every property. So money comes in and PayProp funnels it and says, these funds are for property A, and they can only be used to settle expenses for property A. I can never use property A's money to settle property B's expenses because the money is in separate pipes. It's not just one bucket of money that you scoop out. It really just keeps it in a separate pipe, so I can't cross-fund. So it prohibits you from cross-funding one property's expenses with another. So the first thing it does, it prevents commingling across properties. The second thing that it does, it keeps your fiduciary responsibility towards every single owner peer because you cannot inadvertently break that responsibility. It doesn't allow you to. But then we go one step further. And if you imagine one of those pipes that property A's money falls into, every pipe is subdivided into 3. As the money comes in, the money gets tagged. And it says, this money should be dealt with separately for the landlord. This money should be dealt separately for the tenant. And this money should be dealt separately for expenses. And again, once that separation is made in this pipe, they can't accidentally mix. So I can take my last month's deposit and put it in a property account, and it will run separately, and I will deal with the property account separately. This is money for the tenant security deposit, and that money will flow separately from the other money. And this is money that is meant for property expenses, and that will flow separately. So again, those three aren't put in one bucket in this pipe that it gets received in for the property. It gets internally separated so that those fund types can't mix. Now, it sounds very complicated. Practically, this is what a trust account structure looks like. PayProp sets up an integrated trust account platform for every one of our clients that looks like this. And inside that bank integrated trust environment, and again, we integrate into the banking partners that we work with. As the money comes in, rent is paid. First step is it goes into a separately dedicated trust account for a specific property manager. So again, funds aren't mixed. Funds get tagged around properties. So property funds don't mix. And then internally in this fund separation, landlord money gets put into escrow separately from the receiving account. Tenant money gets put in escrow separately from the receiving account. So these are separate underlying trust environments in which the money is kept, so that internal division in the pipe doesn't break. And then from the rental agency's trust account, we can pay out whatever needs to be paid out. So we pay out beneficiaries, we'll pay out the agency's commission, and we'll pay out property managers. But all of this is done in a bank integrated ring-fenced trust account environment that sits outside of your business. So that if I go back to the three sins of trust fund management, it's impossible for you to commingle these funds with personal funds because it's held outside of your business. It's impossible for you to accidentally do conversion because we separate out these funds in their different fund types within them in this pipe automatically for you, so you can't accidentally do this. And we allow you to account for each owner's property separately down to the last dollar with actual live banking data, not accounting data. And we're able to do this because underlying to our trust account environment, we create these little buckets in which we keep the funds per property separately and account for them separately. And that is what we do as PayProp. I hope this has been a useful session for you, that you understand a little bit more about trust fund management, how to keep trust funds separate, what your fiduciary responsibility looks like, and that there's more to trust fund segregation than just not mixing trust and business funds, but that it's slightly more complicated. And if you'd like us to help you with how to segregate your trust funds, you're always welcome to contact us. You know where to find us. I am low@payprop.com, LOUW@PAYPROP.com. Find me on LinkedIn, send me an email. If you have questions, ask them. If you've got comments, would love them. And otherwise, have a lovely day. Thanks for joining us. Bye.